Hey, thank you so much, everyone. Welcome to my presentation, Market Update, the Fed from Foe to Friend. I'm Gene Goldman. I'm Chief Investment Officer for Cetera Financial. I know you've dialed into these calls or you've seen these videos so many times, so I do thank you again for joining us. What I'll do today is cover our three themes for 2024. And the good news at the onset, they're really optimistic. We're positive about the market environment right now. So with this as a backdrop, let me dive right in. So as you look at this slide, our three themes for 2024 are simply this. Number one, the Fed goes from foe to friend. So what does that mean? Basically, the Fed, the Federal Reserve, they're in charge of monetary policy. They are tasked with a dual mandate. If inflation is too high, they raise interest rates. This slows the economy down. This therefore reduces inflation. If the economy is going too slow, they cut interest rates. And this, in theory, it speeds up the economy and in theory should help economic growth. So the Fed goes from foe to friend. This means that the Fed will go from raising interest rates, which is being a foe, to cutting interest rates in 2024, which is being a friend. Our second theme is that the economy cools into a soft landing. And a soft landing is basically this. It's when the Fed raises interest rates to slow inflation, as they have been doing, but in theory does not push us into a recession. It's a perfect economic environment where the economy is slowing down, but we avoid a recession. It's hard to do. The Fed is, in the last 15 rate hike cycles, the Fed has made mistakes in 11 of the 15 times. But the good news is that we think we get them down. They do it right this time. And our third theme is that market volatility will provide a lot of investment opportunities. We're really terming 2024 as almost like an opportunistic bull market. Not everything will move higher, but the volatility will provide some really good investment opportunities. So let's dive into the first theme. The first theme is simply this. The Fed goes from foe to friend. Again, the Fed goes from raising rates to cutting rates. Why is that the case? You look at this slide. This slide shows inflation over the last, the last 3, 6, and 12 months. And the Fed has a target, and their target is we want inflation below 2%. If you look at this chart, and all these charts are pretty much organized in the same way. Horizontal axis is time, vertical axis is sort of the data point that we're plotting. This chart shows core PCE. So PCE is the Fed's preferred measure of inflation. And there's different ways of looking at inflation. There's CPI, PPI, all these ways to look at inflation. The Fed's favorite measure is PCE. And what this slide shows is that if you take out volatile food, volatile energy prices, core PCE has come down pretty fast, pretty quickly. And I put an arrow there to show you how it's dropped down dramatically. The case and point to focus on is that if you look at the light blue line, that's trailing 6 month. Right now, inflation is below the Fed's 2% target. And obviously, the Fed wants it to be for the entire year, but over the past 6 months, it's been below the Fed's 2% target. Good news. Inflation is slowing down. This is optimistic. This is a good news for the Fed and good for us because this, in theory, slows down the number of Fed rate hikes. There's another reason to be optimistic about inflation on a go-forward basis is this slide. So if you look at inflation today, goods prices have come down, but rent and asking rent and CPI rent, just overall costs of rent are still pretty high. If you think about last year, CPI, the Consumer Price Index, and this is a monthly measure of inflation, the rent component in last year was up about 6%. Let's just say 6.5%. But if you look at asking rent, so these are properties listed on, say, Redfin or apartments.com, properties listed by landlords, new properties, asking rent is actually down. Last year it was down 1%. So you have CPI rent at 6%, you have asking rent down about -1%. The good news is that asking rent tends to lead CPI rent by about 3 to 6 months. So the good news is that basically you'll see further declines in inflation, especially when you look at housing costs. That's great news. Another thing about what's going on with our economy is that the Fed raising rates so much and so fast. Remember, the Fed started raising rates in March of 2022, and they went from 0 to where they are today at 5 3/8. It's put a lot of pressure on the economy. And what you're seeing from the economy standpoint is that the data that comes out is coming in a little bit less than people are anticipating. So let me give you an example. You look at this chart. This chart is the Citi Economic Surprise Index. And what this says really is that Every time a data point comes in above expectations, the line goes higher. Every time a data point comes in below expectations, the line moves lower. If you look on the far right-hand side, over the past 6 months, the data has been coming in less than expected, and the line has been moving lower and lower and lower. So the economy is being impacted by the Fed raising rates. And this makes sense because interest rate costs are higher, borrowing costs are higher, consumer demand slows down. So higher rates are starting to slow inflation, great news, but it's also starting to slow the economy. And then the last point to think about is that it takes about 12 to 15 months for a rate hike to be felt by the economy. Since we started raising rates in March, we still haven't felt a lot of these rate hikes in the overall economy. So this is something we need to be very concerned about, that there's still a lot of economic, downside pressure coming into the economy. So inflation is slowing down. Second of all, you have the economy slowing down because the Fed is pressuring the economy to slow inflation. You take all this together, what this suggests to us is that the Fed goes from a foe to a friend. Foe is one, again, the Fed raising rates. Friend, the Fed is cutting rates. So if you look at this chart, the markets expect the Fed to cut rates this year. And right now, as I mentioned before, the Fed fund rate, their main primary interest rate, is at 5 3/8. If you look at this chart says that the market is saying, based on the data and the analysis and all this other stuff, that by the end of this year, the Fed funds rate will be around 4%. So the market is saying to the Fed, you are going to cut rates from 5 3/8 to 4% by year end. So let's just say 6, maybe 7 rate cuts. It's good news, right? Very, very good news. The question, I'll come back to that in a second because that's not what the Fed is saying, but let me come back to that in a second. A lot of questions we get from you and from other clients is, well, if inflation is slowing down, if the economy is slowing down, why shouldn't the Fed just cut rates like today? Why can't they just surprise the markets and go in and cut rates? Or at their next Fed meeting? Well, there's a few reasons why. First of all, if you think about inflation today, while it is going and it's below 2% now, especially on the more recent readings, overall inflation is still above 2%. The Fed needs to see inflation substantially below 2%. Another reason is that if you look at this chart takes inflation and splits it out into two types. It parses it out into services inflation, that's the light blue line, and then goods inflation, that's the purple line. Goods inflation has come down pretty fast, and this makes sense. Prices for TVs and refrigerators and dishwashers have all come down because we bought all of these during COVID. We don't need them as much as we did before, this because we're buying so many of them. Prices have come down. Services inflation, that light blue line on this chart, that services inflation is still well over 2%. And the only way you can reduce that services inflation is to slow down the labor market, because the labor market is a primary component of services inflation. How does the Fed do this? They keep pressuring interest rates, keep interest rates higher, and they pressure the labor market by keeping rates higher. So that's one reason why the Fed just can't cut rates today. Another reason is that if you look at this chart, and I'm pretty sure I showed you this chart last time, but what this chart shows, it shows 2 points. The dark line is the Fed funds rate. Remember the Fed raising rates and cutting rates? And the light blue line shows you inflation. Look at the red circle on the far left-hand side. So if you listen to Jay Powell, and Jay Powell is the head of the Fed, he talks about the history of the Fed, the mistakes they've made, what they could have done better in their past. And one thing he talks about is the mid to late 70s, when inflation was super high. Jimmy Carter brings in Paul Volcker to run the Fed. And with inflation so high, Paul Volcker, to slow inflation, he raised interest rates dramatically. Then after a few months, inflation starts to roll over. So what does Paul Volcker do? He cuts interest rates. Then inflation comes back again. So he has to raise interest rates. So this whole raising, cutting, and raising really caused a lot of havoc for the financial markets back in the 70s and the early 80s. And that's that red circle. So what Jay Powell has said is that he wants to avoid that mistake, and he wants to see a consistent period where inflation is slowing down and close to or below the Fed's 2% target. So our first theme is that the Fed is going to go from a foe to a friend. They are going to cut rates this year. That's we truly believe. I mean, it makes sense. The Fed's going to cut rates, but not as quickly as the markets are anticipating right now because of the services inflation. The inflation is still not at 2%, and this thing I show you, this whole Twin Peaks perspective. So our second theme is that the economy cools into a soft landing. And this is simply basically we avoid a recession. So our base case for this year is no recession. So let's kind of take a step back. Let's go back to Economics 101. Remember, we learned this in school. We learned this in high school, wherever we learned it. We learned that a recession is when there's 2 quarters of negative GDP. But remember, in 2020, we had a recession, but that recession lasted just 2 months. That's not 2 quarters, that's 2 months. So in reality, the definition of a recession comes from an industry group called the NBER, National Bureau of Economic Research. And what they do is they look at 6 factors, and they are the ones that decide if we're having a recession or not. They look at factors like production. They look at factors like consumer prices, employment. And if you look at this chart on the far right-hand side, these are the 6 factors. And what you see is that all 6 are positive. Great, great, great news. The NBER today is not going to declare a recession anytime soon because their key factors are still well above 0 and they're actually improving. And then we've gotten recent data in the 3rd quarter. We saw GDP was 4.9%. That's not inflation. That's not, that's not a recession. And then we saw GDP for the 4th quarter come in over 3%. Yes, the economy is slowing down, makes sense, but we're not seeing any type of recession anytime near term. So with that said, let's just say that we're wrong or I'm wrong, and maybe we do have a recession. The good news is that it's not going to matter. Our opinion is that the recession, if we have one, and again, that's not our base case, if we have a recession, it's going to be extremely mild. And why is that the case? Because we would envision some type of sector recession. So a sector recession is a recession that rolls through the economy sector by sector by sector. So when parts of the economy are in recession, other parts are doing well. When parts in recession start to improve, other parts start to slow down. So this is very much different than a big, nasty 2008 recession where everything falls at once. This is a recession that rolls through sector by sector by sector, a very mild recession. So again, our base case is no recession, but we would envision, if we did have a recession, a mild sector recession. So let me give you some examples. What's in recession today? Housing, manufacturing, autos. Consumer is not. But if you think about housing today is in recession. But look at this chart. This chart shows building permits. Building permits, these are basically permits by builders to build homes. And you look at the far right-hand side, they've dropped dramatically. Now they're coming back. Building permits are increasing. And then we saw a data point just recently that said building permits for first-time homes or for single-family new homes. So basically, building permits for single-family new homes is up 33% since a year ago period. That's huge. That's good. That's a great number. Also, if you look at sentiment from home builders, these are the companies building homes. Sentiment has been strong for like 6 or 7 straight weeks. So the housing market's in recession, but it's already starting to improve. Another area improving is auto sales. Auto sales here, you see these bars. Each bar represents monthly auto sales. On the far right-hand side, you can see where we are today. Today, we are below pre-COVID levels. We're still in recession. But if you look at that light purple line, that's rolling 6 months. We are getting better and better and better. Auto sales are in recession, but they are starting to come back. Part of it is low interest rate for borrowing costs. Part of it is supply chain fixes. But at the end of the day, we are starting to improve. So again, another area in recession is starting to stabilize. The third area in recession is manufacturing. So there's a lot of manufacturing data out there, but one data point that we look at that it's called the PMI. It's basically a purchasing managers index. Long story short, that it can show you whether the parts of the economy are in contraction, not great, or they're in expansion, really good. Manufacturing today has been in contraction for 14 straight months. That's ugly. That's a nasty number. 14 straight months it's been in contraction. The good news is that the data is starting to improve. We just got some manufacturing readings recently that are showing slight improvement. Plus, if you look at underlying components like new orders, like production, all those other things, these are all picking up. And if you look at this chart here, this is construction spending on manufacturing facilities. It's been, long term, it's been trending slowly higher. Then look at the last about, say, year or so. Boom, it surged dramatically. Manufacturing facility spending has been surging, a lot more construction. And part of the reason is because the CHIPS Act, part of it is nearshoring or onshoring, whatever you want to call it. Manufacturing is in the doldrums, but it's starting to get a little bit better. On the other hand now, so those areas, manufacturing, autos, and homes are in recession, but they're starting to improve and stabilize or improve. What's not in recession? The consumer. You and I, we're not in recession. We're spending money. You're seeing so many data points. That fourth quarter GDP number that came in over 3%, that was driven by you and I spending a lot of money, buying things. Retail sales numbers have been extremely strong month over month. So we as consumers were buying stuff. But the consumer is starting to feel a little pressure. We're seeing credit card debt surge. Today, we have $1.2 trillion of credit card debt. That's a record high. We're also seeing our savings rates come down a bit. We're also seeing student loan repayments are coming in. So a lot of pressures on the consumer. But here's the good news. If the consumer goes into recession, we're coming off of a very strong base. Two reasons. Why? Number one, you look at this slide. This is basically the employment picture. The job market is still pretty strong. So this chart plots number of jobs available out there divided by the number of people looking for jobs. The higher, the better. So in early 2022, we had 2 jobs for everyone looking for a job. Today, we're at 1.3. It's come down because the Fed has raised rates to slow the economy, but we still have more jobs out there than people looking for jobs. Anyone out there that wants a job can get a job. They can find a job. Even people out there that don't want jobs, they can get jobs. There's so many jobs out there. Another reason, if you look at this chart, look in the upper part. The upper part is it's consumer debt divided by income. And on the bottom shows the Fed funds rate, the Fed raising interest rates. Despite interest rates moving higher, debt to income on the top is still pretty flat. Why is that important? Because basically there's less debt servicing. Good news, that's better for us as consumers. We have less debt relative to our income. And also most of this was driven by the fact that 90% of mortgages out there today are either 15 or 30-year fixed. So even as the Fed has raised rates to slow the economy down, our mortgage payments have not really increased that much. Good news, consumer is in great shape. And then another point I mentioned earlier, retail sales, consumer is in really good shape. You look here, for example, where the red arrow is, this is monthly retail sales. It's been improving month over month over month. Good news, consumers in great shape. So taken together, all we're saying is that if we have a recession, which is not our base case, if we have one, it's going to be extremely mild. It's going to be a sector recession where parts of the economy in a recession start to stabilize, other parts doing really well start to weaken a bit. That's a mild recession. One last point I want to talk about regarding the economy is this slide right here. So this slide shows you, it's a very complicated slide, but let me explain it to you. It shows 2 data points. The purple line, the dark line, is productivity, and the light blue line is labor costs. So labor costs are rolling over, coming down. Okay, they're slowing down. Which is good. This is good for companies because it's great for profit margins. Companies are spending less money on costs, so therefore profit margins are improving. And we'll talk about this in a second. The other perspective is that purple line. Look on the far right-hand side. See that little hook that goes up? That is such an important point. That is productivity, and productivity is surging right now. And why do we care about productivity? So productivity usually only surges at the end of a recession as we go into a recovery. So let me say it one more time because this is so important. Productivity only surges when we are leaving a recession and going into a recovery. So let me give you an example. So let's say that me, Gene Goldman, I have a manufacturing company. And my manufacturing company, I produce widgets. So I'm producing all these widgets. Then we hit a recession. So you know what I do? Unfortunately, I have to lay off workers. So I start to lay off some workers. But we're still functioning in a recession. Then all of a sudden, let's say that as the recession starts to end, we start to see a recovery. When we start to see a lot of companies calling me and saying, Gene, we want to buy your widgets because we are in a recovery. So the economic growth starts to pick up. But for me, I'm a little scared because we're still in a recession. I don't know when I need to hire more workers to come back. So what I do is I ask my workers, hey, we've got more demand now. I can't hire more people. I need you to produce more stuff. So you've got fewer workers on the denominator, producing more stuff on top, on the numerator. This is a surge in productivity. Why is that so important? Well, because again, they only occur usually at the end of a recession or as we go into a recovery. All this says to me, this productivity number, is that either we don't have a recession this year, which again is our base case, or more importantly, maybe we already had a recession. We just didn't feel it. It was so mild. And that's a really important point. Maybe the recession already took place. Either way, recession or no recession, we don't think it's going to matter. We think any recession will be extremely mild. We think the economy will do well. We think the Fed navigates us into a so-called soft landing. So first theme, the Fed goes from foe to friend. Second theme, the economy cools to a soft landing. The third theme is market volatility is going to surge, but it's a normal part of investing and it provides you investment opportunities. We're opportunistic with this volatility. So let's talk about market volatility, first of all. If you look at this slide has a lot of bars and other stuff. What this chart shows, it shows you the S&P 500. So that's our broad market benchmark. Returns of the S&P 500 year by year by year since 1980. The bar goes up, stock market is positive that year. Bar goes down, the stock market is negative. And then below each year, there are these little red rectangles. And that shows you the intra-year loss. So what does all this say to you? What this says to you is that the stock market has been positive in 36 of the last 44 years. Great news. Basically, about 80% of the time, the stock market has been positive. The stock market has an upward bias. That's great news. But if you look at those red squares, that's the intra-year loss. That's the downside. That's the weakness each year. That's the volatility. Despite the market being up 36 out of 44 years, the average intra-year loss, the average downside, volatility, whatever it is in that year throughout this whole period is negative 14.2%. So what does this mean? That means volatility, these big swings in the market, these movements are a normal part of investing. Think about last year. Last year, at the end of from July to October 27th, we had a correction. Stocks fell over 10%, but then boom, stocks came back. So I'm not guaranteeing anything. Please don't take it that way. All I'm saying is that market volatility is a normal part of investing, as you see here, but it provides some good investment opportunities. So to provide a good investment opportunity, you have to be optimistic about stocks. And we are right now. First reason, if you look at this is quarter by quarter earnings growth for the S&P 500, so earnings. And if you look at the far right-hand side, these are earnings expectations, the light blue boxes. We believe the earnings recession is over. That means earnings falling year over year. We think it's over. We think going forward, earnings will be in a better shape. And there is the old perspective that earnings drive stock prices. We think earnings are improving dramatically. Part of the reason that they're improving is the economy is better than expected. Part of the reason is, remember, labor costs are starting to slow down. The other reason is that, look at this thing. This is plotting inflation again, but this is plotting two other types of inflation. CPI, Consumer Price Index, is what you and I pay for stuff. And then Producer Price Index, this is what companies pay for stuff, their underlying business costs. So if you use Producer Price Index, and that's that light blue line, as a proxy for business costs, and the CPI, the purple line, as a proxy for business sales, what you're seeing is that business costs are falling at a faster rate. This is very profit margin positive. This is good for profit margins. And then you add on top of this, again, labor costs are slowing down, inflation is slowing down, interest rates are slowing down, all good news. We think the earnings recession is over. It's great for stocks. So our three themes: Fed goes from foe to friend. Number two is that the economy cools to a soft landing. Number three, market volatility is here, but we get a lot of good investment opportunities. So that's all great news, but there's always some risks out there. And let's talk about some of these risks before we end today. The first risk is that everyone is bullish right now. Everyone is excited. Everyone just wants to buy stocks. At the end of last year, you look at this chart. This chart plots the number of people who are bullish, who are optimistic, subtract out the number of people who are bearish, who are concerned about the markets. And that red circle shows you at the end of last year, everyone was bullish. Everyone was saying, let's buy stocks. This is an inverse indicator because if everyone is excited about buying stocks, that's a big red flag. It's inverse. So we're watching. This is a risk to the market that everyone thinks that there's so much good news. Another thing to look at is valuations. Stocks are expensive. This is the PE ratio, the price earnings ratio of stocks. Today, if you look on the far right-hand side, it's about 19.6. Long-term average is about 17 and change. Because of this market moving higher, this bullishness, this optimism, valuations are high. The good news is that you can have high valuations when you have low interest rates, low inflation, but high valuations priced in absolute perfection, something we have to be concerned about because not everything is going to be perfect. Another reason to be concerned, a risk, is that maybe there is a recession. Maybe there is a big recession. You look at this chart. This is the leading economic index. It's 10 indicators that give you a high frequency look at the economy, like manufacturing hours worked, like employment, jobless claims, a bunch of different data points. And what you see on the right-hand side is it's down dramatically on the far right-hand side. And the thing that worries us is that every time it's hit this point, if you go back to the chart on the left, you see a gray bar, and the gray bars are recession. So every time it's hit this point, we've had a recession within 12 months or so. Again, that's what the history says. We don't believe it because we think, this index is about 7 of the components are very manufacturing related. Remember, manufacturing is in recession. So we're not too worried about this right now, but this is a possibility that maybe there is a recession coming. Maybe we're wrong. We don't believe it. We think the economy is okay. And of course, there's other risks. Like you can look at China potentially with their issues with Taiwan. You can look at the Houthi rebels. All these things are concerns for the markets. But what we're doing is we're watching real-time commodities to better estimate the impact in terms of the potential impact. And like if you look at the price of copper, look at the price of wheat, look at the price of oil. These tend to give you indications of any uncertainty that the markets are worried about. All three are flat to a little bit down. So we're not too worried about them, but we're watching them very carefully, trust me. And the last point, the biggest risk we see out there today is the Fed right now. And I know this chart is a little bit like really hard to read, but what it says is that this is from the Fed's dot plot. This is their summary of economic projections. This is what they produce once a quarter. And they say as the Fed, this is where we see interest rates, inflation, economic growth in the labor market. And if you look at the little red square, all this says is the Fed says for 2024, we will cut rates 3 times and no recession. So we will cut rates 3 times and no recession. The market, as I showed you before, said, well, we don't really believe you. We know you're going to cut rates 6 times, maybe 7 times, and we're not sure about a recession yet. The markets are pricing a recession might be coming. That's why you'd have more rate cuts. So again, the Fed says 3 times, the market says 6 times. Complete disconnect. That's a big risk we're worried about. We think the right number is about 4 times, just because the economy is a little bit stronger than expected, but at the same time, inflation is rolling over. But something the market needs to grapple with. So this is why you're seeing a lot of recent market volatility. So again, our 3 themes are: number 1, the Fed goes from being a foe to a friend. We have an economic soft landing, and market volatility creates some good opportunities. What do you do as an investor? What should you do? And there's 2 things I always tell you. Number 1, be diversified. Have exposure to different parts of the market. You look at this chart. This shows the valuation levels of different key asset classes. The one at the top, that purple one, that's large cap growth. That's like tech stocks. Look at how high it is relative to its average. The PE ratio on growth right now is at like 33. The average is what, 21, 22. Look at the other asset classes. They're all trading close to their average. Be diversified, have exposure to different parts of the market. But the key point is, I always say, number 2, you need to be in line with your long-term objectives. You can't be too conservative or too aggressive in terms of diversification. How do you do this? Stay in contact with your advisor at Wild Wealth Management. Stay in contact with them, get in front of them. Any changes to your lifestyle, to anything about you, your situations, keep them updated, because they need to make sure your portfolio is aligned with your long-term objective. Well, that's it. I really want to thank you. 2 things, please, if you want to follow our team on X, formerly known as Twitter, Cetera IM, or follow me, at Gene Goldman. One of my 2024, basically my 2024 plans is that I want to actually have more Twitter followers than my mother does. My mother has more Twitter followers than I. It's hard to compete with my mom because she tweets about New England Patriots. She's a big Patriots fan. She tweets about animals that need to be rescued. So it's hard to compete with that because I'm tweeting about CPI. So I'm a little boring. But I do want to thank you. I need to show you these disclosures. And yeah, I hope you see these all. I hope you read these carefully. And again, thank you so much and have a great rest of the year. And thank you.